Hello, good morning. We have started with our new topic, and that is retirement of partnership in a partnership firm. What accounting entries are to be passed? What is the treatment given for goodwill, treatment of goodwill? That also I told you. Then how to find out new ratio. For example, if there are three partners, 5:3:2, if B retires, new ratio will be 5:2. Just ignore the ratio of that partner who is retiring, and the remaining will be the new ratio. Now, as I told you, there is no change in the preparation of revaluation account or profit and loss account. It is same as you have learned in your admission of partner, but profit or loss on revaluation will be shared or credited to all partners, whereas it was only to the old partners in case of partnership firm. Second, general reserve P&L account, you have to credit to all partners including retiring. If there is profit and loss account given on the asset side, it will be debited to all partners including retiring partner. This is what I have already told you. Now today we will see some problems which were asked in your board exam. So those problems I will be showing you the answers and practically how to solve the problem. Now let us see a few problems. In the first problem, which I am going to discuss now, in that problem, journal entries were asked. So you have to be perfect in passing the journal entries. You must know how to pass the journal entries, because generally what happens, student go on solving the problem directly by opening account and orally they do entries, but actually when they want to write the entries, they might get little bit delayed in answering. Second thing, even though the journal entries are asked, there are certain things which are clearly given in the question. So those you can write the journal entry. For example, increase or decrease in liability, appreciation, depreciation in the asset. That is given in the question. But general reserve, these three things you can do directly, but you will have to prepare rough revaluation account, because you will have to find out the profit or loss, and for that you have to pass the journal entry. So rough account you will have to prepare, giving the effect of your journal entries, find out profit and loss and pass the entry for that. Similarly, you will have to prepare retiring partners capital account, even though not given in the question, because you have to pass the entry for amount payable due to partner. If it is paid, then you have to pass the entry retiring partners capital account debit to cash bank. So for this you will have to prepare the account, or if it is transferred to loan account, you have to close the account, find out the amount due to partner, retiring partner, and then pass. So these two entries cannot be passed unless you prepare rough as a working note, revaluation or profit and loss adjustment account, and at least retiring partners capital account. Now let us try to see the question which was asked in your board exam. Now, this was the problem which was asked in your February 2015. Now, the problem was very simple because there was no adjustment for goodwill and there was not much things to be seen. Now see, given below is the balance sheet of Vaishali, Madhuri and Shobha, who were sharing profits and losses in the ratio of 5:3:2. Balance sheet as on 31st March 2012 was as under: cash, machinery, debtors, stock, furniture, building. And on the liability side, creditors, bills payable, capital account, Vaishali, Madhuri, Shobha, reserve fund 16,000. On 1st April 2012, Shobha retired from the firm on the following term. So immediately you mark who is going to retire, because on that account you have to concentrate. So mark this. She is going to retire, so you have to concentrate on that her account, because amount is payable or whatever that we'll see. Now next, assets to be revalued: stock 24,000, machinery 32,000, and furniture 16,800. RDD to be maintained at 4%. An item of 400 from creditors is no longer a liability and hence should be properly adjusted. The amount due to Shobha be transferred to her loan account. Pass necessary journal entries in the books of the firm. So here only journal entries are asked, so you need not prepare revised balance sheet after retirement, first of all. Second thing, you need not prepare capital accounts of continuing partner. Remember, don't waste time in exam. You have to read the problem very carefully. Now, which entries you can pass without whatever given in the adjustment information? So first, transfer reserve. Reserve fund account debit to Vaishali, Madhuri, Shobha's capital account in the ratio of 2:2:1. Now, stock is revalued. So revaluation account debit 6,000. Now there is reduction in the value of depreciation in the value of stock, machinery and RDD. So RDD liability is increased. So revaluation account debit to all partners capital account. Next. So this you can do directly. Now coming to next adjustment. Now there is appreciation in the furniture account by 800 and reduction in the liability. So it is a profit or gain to the firm. So revaluation account is created by 1,200 and furniture account debit, creditors account debit to revaluation account. Entry for appreciation of furniture and reduction in creditors credited to revaluation account. Now, after this, you will have to prepare revaluation account, because this loss or profit, in this case, there is loss. So, stock is on the debit side 1,200, decrease in the asset, machinery reduction in the asset, already increase in liability, so 6,000, and loss is debited to partners capital account and credited to profit and loss adjustment account. So I told you have to prepare retiring partners capital account, 2 loss on realization, opening balance, reserves, and then amount due to her is transferred to loan account as per the adjustment. So 2 loan account. So the entry will be Shobha's capital account debit to Shobha's loan account. So this will come in the new balance sheet. So this is how you have to prepare. The problem was very small and easy, but don't waste time in preparing balance sheet, capital accounts of continuing parent, etc. So this is how you have to solve. Now I will go to next problem. In the next problem, the board has given the adjustment as regards goodwill. Then other adjustments are similar to admission, that is appreciation or depreciation in the assets, increase or decrease in the liability, etc. Now, in this problem, goodwill, as I told you, goodwill of the firm, what is the treatment? Goodwill of the firm raised and written off, what is the treatment to be given? Now, if the share of goodwill of partner is given, retiring partners is given, if it is raised to the extent of his share, and if it is written off, then what is to be done? Now, in the February 2016, there was adjustment as regards goodwill. Now, let us see what are the adjustments given in the question and how to solve it. February 2016, the balance sheet of Anand Traders, Varda, is as follows. Partners share profits and losses 5 upon 10, 2 upon 10 and 3 upon 10. Asset side, plant and machinery 32,000, factory building 40,000, stock 20,400, debtors 16,800, gross less RDD 800, net is 16,000, cash 12,400, total is 1,20,000. On the liability side, it is Sunil's capital, Pankaj's capital, Paresh capital, creditors, general reserve. Pankaj is retiring, immediately mark who is going to retire. He is retiring. Now, the assets were revalued as under. Stock 28,000, factory building is to be appreciated by 10%, reserve for doubtful debts is to be increased up to 1,000, plant and machinery is to be depreciated by 10%. The goodwill of the retiring partner is valued at 8,000. So his share of goodwill is given and the remaining partners decided that goodwill be returned back in their new profit sharing ratio 5:3. Now, if adjustment is given regarding treatment of goodwill, then you have to give the treatment accordingly. What I mean to say is, the adjustment says that write back goodwill in new ratio. So you need not find out gain ratio. See, when you have to find out gain ratio will be found out when new ratio is given, but instructions are not given that write off goodwill in this ratio. Again, I am repeating what I say. If new profit sharing ratio is given, then you will have to find out gain ratio for writing off the goodwill. But since in this question the problem says that write back goodwill in new ratio, then you have to do it accordingly. Don't go and find out gain ratio. But in this problem, what has happened? Fortunately or unfortunately, if this partner is getting retired, Pankaj is getting retired, his ratio is gone, so new ratio is 5:3. So gain ratio is also same. So that is the case. But again I am telling you, if instructions are given that write off goodwill in the new ratio, then write accordingly. Don't find out gain ratio. Amount due to Pankaj is to be transferred to his loan account. So cash account is not affected. So that will remain as it is in the new balance sheet. Now coming to the adjustment. Now regarding RDD. Now RDD, reserve for doubtful debts, is to be increased up to. See, this word is very important. Increase by or up to. Increase up to means from 800 to 1000. And it is increased by means directly increased by 1000. So here, since it is given that it is up to 1000, so from 800 to 1000, so the effect is to be given is only for 200. So 2 RDD, 200. So in the balance sheet, you will see that debtors 16,800 less RDD, revised value, minus 15,000 net figure. So this is you have to give effect immediately. Now next adjustment is plant and machinery. Plant and machinery to be depreciated by 10%. So plant and machinery is 32,000 less 10% depreciation. Difference will come here, as I told you at the time of admission. 3,200 loss, debit side of revaluation. Then deduct it from the asset side. Revised value 32,000 minus 3,200. Outer column 28,800. Now next adjustment. Stock. The question says that stock revised value is given 28,000. What is the book value? 20,400. So there is appreciation of asset, that is stock, by 7,600. Appreciation will be credited to revaluation account and it will be shown on the credit side of uh, revaluation account because there is appreciation in the asset, and then second effect, it will be added in the balance sheet. Stock appreciation by 7,600. Revised value given in the question is 28,000. Next adjustment is regarding factory building. Now factory building says factory building to be appreciated by 10%. Factory building is 40,000. Appreciation by 10% credited to revaluation account, then it will be added in the new balance sheet. 4,000 out of column 44,000. So revised values, stock 28,000, building 44,000, debtors 15,800, plant and machinery 28,000, cash balance as it is, no change, it will be recorded as it is. Now coming on the liability side, now there is only one liability, creditors. In creditors, there is no change, so that figure will be shown as it is in the new balance sheet. This is no change. Now coming to partners capital account. Now the adjustment says that goodwill is 8,000. Share of goodwill of retiring partner is 8,000. So 8,000 is here. So we have written opening balance of retiring partner, all partners. Reserves are given as per the as per the profit sharing ratio. Profit on revaluation 4,100, 1640, 2460. Goodwill is which is belonging to retiring partner valued at 8,000. So the journal entry is continuing partners capital account debit, that is Sunil's capital account debit 5:3 ratio, Paresh capital account debit to goodwill 8,000. Actually here you have to write by in bracket, then you have to write down the partner's capital account, continuing partner 8,000. So this is how you have to prepare partner's capital account, close partner's capital account. Balance in the continuing partner is 47,200. Close this. Balance due continuing is 21,200. It will be shown in the new balance sheet. Revised figure. Continuing partners capital account for next year. Opening balance for them. And the adjustment says that retiring partners share due to him will be transferred to loan account. So you will write close account, loan account, and here it will be Pankaj's loan account in the balance sheet, amount due to him payable by the firm, and thus you have to close the balance sheet. This is how you have to solve the question of retirement when goodwill is given. Now coming to next problem is now third problem was little bit lengthy, which was asked in your board, and that was in it was in July 2015. Now in July 2015, there were two adjustments in which as regards goodwill, and in the question it was given the revised capital or new capital of continuing partners. So like admission, as I told you, that in the case of admission, when you have to find out new profit sharing ratio as per the new capital, what we have to do, that we already discussed. Difference is to be transferred to cash account or bank account or current account or loan account, as may be the case. Similarly here also, but generally in the retirement, cash is brought in by a new partner, a continuing partner, for settlement of dues to the retiring partner. So in the case of retirement, if new capital is given, and in that case, how to find out new capital, how to give the treatment of cash to be brought in by new continuing partner, that we'll see. Now, regarding goodwill, in this question, you will have to find out gain ratio. See, I am trying to cover problems which are having various adjustments regarding treatment of goodwill, regarding new adjustments of revaluation account, assets and liability, so that based on this you can practice remaining problem at home. Now coming to third problem that we'll discuss, and those are that is which was asked in your February 2015. July 2015 retirement. Following is the balance sheet of the firm of Sonu Monu PU, who share profits and losses in the ratio of their capitals. So ratio of capital means this capital, 5:3:2. Profit sharing ratio is given, which is as per the capital contribution. So you must find out what is the new ratio, ratio of all partners, that is 5:3:3. Now creditors are given on the liability side. Now the question is plant and machinery, land and building, stock 12,000 gross RDD, debtors less RDD, outer column 11,000, cash 17,000. Now PU retires. PU means immediately you should mark who is going to retire. So now adjustment. PU retires on 31st March 2013, and the adjustments were stock to be valued at 92%. So little bit different adjustment. So instead of giving depreciate stock by 8%, new value is given. That is, it is equal to 92%. So there, in other words, you will have to find out that there is a depreciation of 8%. So this is new thing which was asked in your exam. Little bit trick they have used. So 8% is depreciation or reduction in the value of asset. RDD to be maintained at 10%. So again, this 10% you have to find out on gross figure, not on net figure. That you should remember. RDD percentage is always found out gross figure, not on net figure. Remember. Now, goodwill of the firm fixed at 12,000. Piyush's share in the same will be adjusted in the capital accounts of continuing partners in the gain ratio. Now, I told you when to find out gain ratio. Next adjustment, next information. Between Sonu and Monu, in their new profit sharing ratio, fixed at 3:1. Remember, ratio of new partners, continuing partners is given. So, in this case, you will have to find out gain ratio. Next adjustment. By making, see again I will read. The entire goodwill of the new firm be fixed at 1,60,000 between Sonu and Monu in their new profit sharing ratio, which is fixed at 3:1. So new capital is given, combined capital of continuing partner is 1,60,000. Then new ratio is given. So new capital will be 3/4 into 1,60,000 and 1/4 into 1,60,000. So new capital is 1,60,000. Sonu's 1,20,000 and Monu's 1,40,000. So this is new capital which will come in the new balance sheet. This is new adjustment asked in your exam. Now coming to the, so this is new thing. Now coming back to your other adjustment. Now stock 8% depreciation, so 8% on 12,000, so it is 960. Stock written off. RDD 10% on 12,000 is 1,200. Old is 1,000. So the difference is 200 will come here. Now land and building to be appreciated by 20%. Land and building 55,000. Appreciate by 20%. So appreciation is 11,000. Accordingly, find out new profit sharing ratio as per 523 9840. Now coming to your balance sheet, capital accounts, buy balance brought down 50,000, 20,000, 30,000. Profit and loss adjustment account, profit on revaluation 4,900, 1968, 2954. Now goodwill I will tell you. Now the goodwill says, treatment of goodwill says that goodwill is to be, goodwill of the firm is given. See, goodwill of the firm is given. So you'll have to find out how much amount is belonging to the retiring partner. So that comes to, I'll show you how to find out gain ratio and how to give the treatment. Now I'll read. Since goodwill is to be adjusted in the account of continuing partners, I'll read slowly. Since goodwill is to be adjusted in the account of continuing partners in gain ratio, we have to find out the same. The profit sharing ratio of existing partner is 5:2:3. That is in the ratio of capital. And new profit sharing ratio of continuing partner is 3:1. Formula: gain ratio is equal to new ratio minus old ratio. Gain of Sonu, new ratio is 3:1. Old ratio is 5:10, 5/10. So LCM is 20. So 15 upon 20 minus 10 upon 20 is equal to 5 upon 20. Gain of mono, new ratio 1 upon 4. Odd ratio 2 upon 10. So gain is 5 upon 1. Gain ratio is 5 is to 1. 5 upon 6, 1 upon 6. In this ratio, goodwill will be debited to partner's capital account. 5 is to 1. And credited to continuing partners. Retiring partner. Continuing partner's capital account debit to retiring partner. This is how you have to find out give the treatment of goodwill. Now, the problem in which it is given that the cash is 17,000. Try to understand. Cash is 17,000. But amount payable to retiring partner is 36,552. So, the continuing partner decided to bring the goodwill cash by revising the capital. So new capital is this. By closing this, you get a cash requirement of. So cash is brought in by new partner, continuing partner. Sorry. So cash is brought because new capital is 1,20,000. Now, so cash account debit to Sonu's capital, to Monu's capital as per the revised capital. And so, for this purpose, it is better to prepare rough cash account. And so, two balance brought down. Cash account debit to Sonu's capital. Cash account debit to Monu's capital. Thus, cash balance has gone up to 1,03,000. And out of that, amount payable was given to PU. So PU's capital account debit to cash. And remaining amount, balance, closing balance, is shown in the new balance sheet. And this is how you have to prepare balance sheet after all the adjustments and accordingly. So today we learn three things. You must know how to pass the journal entry. If journal entry question is asked, you will have to prepare rough revaluation account and find out profit or loss. For that you have to give the effect in the entry. Similarly, you have to prepare retiring partner's capital account because entries to be made for that. Retiring partner's capital account debit to loan account or cash account. This is what we learn in the first question. In the second question, treatment of goodwill, journal entry, when you need not find out gain ratio because the question itself says that write back goodwill in the new profit sharing ratio. So don't waste time in finding out gain ratio. And in the third problem, we learn two new adjustments. And that is how to find out gain ratio and what entry you have to pass. And then if capital accounts of continuing part, capital amount, total capital of continuing partner is given, then how to find out new capital of continuing partner, since new ratio is also given. So new ratio into total capital will give you new capital, and that will be shown on the debit side of partner's capital account of continuing partner. Close capital accounts of all partners. Find out amount receivable or payable to the continuing partner as per the new capital, and then make the payment or loan. In this case it was payment, so make the payment to the retiring partners which was due to him, and the entry was retiring partners capital account to cash bank account. So today we will stop and we'll try to see few problems next time on retirement, and then if time permits we will switch over to death of a partner.